It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
Welcome back to Real Vision. I'm Ash Bennington. We're joined today by Ron William, CIO and macro tactical strategist at RW Advisory. Ron, welcome back to Real Vision.
Great to be back and happy summer greetings.
Well, it's great to have you. Listen, Ron, we were talking before the show, lots to talk about in the macro space, rotation, what's happening in U.S. equity. It's just so much happening right now that's grabbing the news cycle right now, mid-July 2024. Ron, where do we begin?
Well, a quick recap on the approach that it's global cross-asset, macro top-down, ultimately grounded in behavioral technical analysis and driven by cycles. I'll just pin that as a reminder or refresh for those watching again. But what all of that means is, as part of the mix of the business cycle changes in season, we continue to be in this greed and fear rotation. And that's probably one of the key feature charts that I think helps illustrate the picture of what might be happening right now. But just before we jump there, we have an opening humorous but insightful cartoon. Picture speaks 1,000 words, cartoon even more. And it's a credit to Ed Hedgeye. The bull in the water being held up by these inflatable balloons. No surprise, it's the MAG 7, 5, and now 3 or 1, depending on which one is leading and which one is not. Of course, there is a rotation between the best of the best and now the laggards year to date in terms of value. We can speak a little bit more about that, but the long and short of it is it seems to be fast rotation, not sustainable. And although the rally is extending higher, it's getting thinner and thinner, more fickle and fickle, and there's lots of divergences that are developing.
Well, Ron, let's talk about that. And I think this is just such a great cartoon. Everybody who watches markets sees that. They get it, the joke immediately. We all feel it, this sense of high concentration, a lack of market breadth in this rally, record highs on U.S. equity indices. And yet this sense of maybe, I don't want to be too overstate it, but there is a little bit of like ominous foreboding, right? With this sense that, gosh, it is just these, as you say, 3, 5, 7 stocks, that are propping up the market. How do you think about that? How do you measure it? And what is it that it says to you about the broader context of U.S. equity markets?
Well, it's the same story that remained true for most of last year. Concentration risk was exactly that story. And yet the market stayed strong, not for the entire time. It did ebb and flow. We did have a big drawdown in Q3. My view is we will likely have another one this year coming up from August onwards, especially ahead of the US elections. This year, more than any other year, we've had geopolitical and election-related volatility 40 or even 70, if you want to total it up, plus elections around the world. And they're all make or break events in terms of market impact and in terms of polarization and a lot of uncertainty that remains with us, if not has increased. So all of this means is we still continue to trade the markets, and if it's going up and you're long, stay in it. But prudence is key, and being able to take profits when necessary, looking to hedge, particularly as we go into this negative seasonality window of Q3 from August onwards. And everyone knows that the best pattern of it all is September and October. That's when vol typically spikes up, particularly when the Sharpe ratio has been at record complacency levels for most of this year.
I should say, by the way, that we're recording this here Thursday, July 18, 2024, at around 3:30 p.m., just about 30 minutes from market close. And what I'm looking at on my screen is a whole lot of red ink. Russell 2000 is off some 2% on the day. S&P 500 down about 1%. Dow Jones Industrial Average down a little bit less than 1.5%. One of the things that gets discussed with this equity market, well, there are really three things. It's all-time highs, number one. Number two, concentration. And number three is the rotation that we've seen into and out of small caps. Talk a little bit about this. Those are the sort of the three major themes that I see in play. How do you think about it, and how do you reconcile those positions?
So I believe there's this thesis which has existed for some time now, dubbed the behavioral inflection point. I truly believe that we're in this late stage cycle on borrowed time, but more importantly, this gold trap in action, in motion, that is going through. Now, timing it has been hard as hell, and that's of course what we've all been watching our screens and trading our book in terms of keeping it focused on market price action, keeping our biases in check, and then applying risk management where necessary. One way that I help stay objective is this opening chart here, which is my radar screen from week to week, looking at a cross asset rotation, which currently shows a transition between greed and fear. And there's has been this bifurcation for some time in the markets. Now, just as a brief explanation of what we're looking at, it's three columns measuring trend over time. So the motion of trend and cycles as it changes. And from the left to the right, you have a long-term strategic, middle, tactical, medium-term trend, and then on the right, active short-term. And what it shows is you have...
So that means that basically moving from left to right, you have longest time duration to shortest time duration, and moving from the bottom to the top, you have the weakest to the strongest.
Exactly that. And basically when you have, and it's color coded in terms of asset class, it is cross asset. And when you see, the same asset class, rising across all three time frames, then it's a strong trend over time, and vice versa on the downside. Sometimes, as is the case now, you get a little bit of flip flop and fast rotation between each of the assets. And typically we get a risk on, risk off consensus or broad global trend. That's not what we've had for a while. So equities have obviously been elevated for some time as part of that risk on proxy. Bitcoin coupled with that, we're seeing both of those greed assets for now unwind. And as you just saw, at time of this interview, we're seeing a little bit of a tactical mean reversion. One thing I would highlight to everyone is that chart on the right, top right, figure 2, S&P 500 testing its short-term tactical 20-day average, and that's support levels at 55.35. So for when they watch this back, we're either testing it or breaking it or holding. Time will tell. But that's definitely showing up on the radar screen. You can see in blue, USA has been top right until very recently on the latest drop that we've seen. So it's had a fall from grace, so to speak. While safe haven assets like gold, which is acting like real money these days, remains elevated, even though it's sideways and consolidating. And then we have emerging markets still leading the way, such as India. And then look at the bottom in terms of the negative outliers, rates, just going through a tactical unwind, although my view is still medium to long-term bullish, higher for longer, as part of a long-term cycle view and an analog going back to the 1970s. And then if we look at the commodity story, which I've been bullish for year to date, that is now unwinding as it became overbought too much too soon. You can see copper down at the bottom.
Well, this is such a great slide that we're looking at. This is just truly rich, information dense visual that you get from that. And my takeaway is when you just look at it, it's the points you just made. Boy, first of all, when you look at the weakest, it's just 10-year treasury at the bottom across all time horizons. And then look at the top. I see gold, 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 and pinned to the upper left hand corner, which is the strongest strategic play, gold.
I mean, so gold, all-time highs, and although it's going sideways in dollar terms, which is what everyone is typically watching, check it out across world currencies. I think on some platforms it's WCU for world currency, and you'll just see it's also at all-time highs. So you'll get some ebb and flows, variations based upon different currencies. The pound here in the UK is strong post election, so you're likely going to have more buying power on that side. But generally speaking, whether it's the major currencies, the emerging markets, or some of the gold resource markets, gold has been holding strong, and that's partly a commodity story, a FX debasement story, and just a strong trend story that remains holding. And of course, from a relative performance perspective, gold remains attractive, as does silver, as a high beta play, and these are things that people can keep in mind. And just to complete the picture of this chart mosaic, bottom right, figure 3, what's changed on the macro side from a behavioral point of view, and that's the main focus of my work, behavioral sentiment fueled by cycles. We can see this right here and now in terms of macro surprise indices below zero for the last in recent months. You can see that's across 3: Citigroup, Bloomberg, and Goldman Sachs. And of course, that's slower GDP out of the US. That's, stickier inflation than expected. And then more recently, the labor numbers, which seems to be a little bit skewed right now, but still, it's keeping many of us guessing in terms of how all of that is going to unwind in the second half of this year.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
The more I stare at this slide, the more I see, and it's really a great one. The other pattern that I just noticed, which is really interesting, is China versus the USA. When you read this chart from right to left, like Arabic or Hebrew, you see this gradual step down in China from positive sentiment for relatively moderately positive or neutral sentiment, I guess, from the shortest term time horizon down to weak from intermediate time horizon, and then weakest over the longest time horizon. Conversely, when you look at this chart from left to right, you see the exact opposite. You see the strongest positioning and the strongest quadrant for the US over a longer strategic time horizon. Then you see tactical a little less strong, and then you go to weak from an active perspective. It's really interesting to see that, because what it essentially says is kind of the opposite of probably the broader story that we've been reading about for decades at least, which is you see a secular deceleration in the strength of Chinese markets, according to this table, and a secular strengthening for US. I don't know, am I reading that wrong?
Absolutely correct in terms of the latest rotation, which is basically the elastic band effect. I mean, everything that's been strong is now unwinding from up to down, and then vice versa
Right.
for this markets, China being a case in point, although that was a catching the falling knife phenomena for some time. And there are some China bears out there that are also concerned on the macro side. So it depends on your view, but certainly the alternative to China for a lot of Asian clients that I work with, and some here in the West, has been Japan. And of course, that remains strong unless macro or geopolitically of a concern. But then your point about timing, yes, so I would only reframe the word secular, because which I do use in my cycle work. Secular typically alludes to multi-year, sometimes multi-decade. Here we're looking at, if I were to simplify it in calendar timeframes, tactical monthly, active monthly, tactical quarterly, and strategic annual. So if you just think about literally those calendar dates that dictate our lives and our portfolios, that's essentially what we're doing. I add some relative performance and some timing cycle filters, but the reason why this is so powerful is it just keeps us all on track in terms of that cross-asset rotation mix. Sometimes it's just traffic light signals, and there's a lot of gray, so to speak, in terms of noise in the market. Right here and now, we're starting to get some tangible lead signals of a live rotation. And of course, it's also a confluence that is taking place. And our next slide focuses on why I'm more concerned now than before, because of this ongoing triple whammy headwind. What I've basically pinned down to 3 factors: momentum extremes, rotation fragility, and cycle risk. And we just touched on the first 2 already in terms of the all-time highs and in terms of the opening cartoon about the bull sinking in the water, but still holding that concentration risk in the hot air balloon. So with some rotation that's been taking place. Now, if we just look at the charts in terms of big picture of what's happening, that behavioral inflection pattern that we've been discussing at the top here, I've now redubbed the runaway behavioral inflection pattern, because clearly whenever we get an unwind, we just run up again. And now we're thinning out into this narrow momentum market as well as rotation. Now, the trend is our friend. Don't fight the trend, don't fight the Fed or anything else that looks like a moving train. But caution right here and now as we get the market unwinding from super overbought conditions. And probably the best thing to do in this type of environment where the market is leading despite so many different dislocations, tactical and strategic, is to wait for a potential rollover. And the key level there is the 20-day moving average, as I just highlighted, at 55.30. For anyone who's trigger happy or just waiting for an alert signal. But then more than that, I would say any signs of momentum exhaustion will likely lead to a bull trap signal. Think about all of those super bullish, leveraged investors and traders suddenly getting it wrong. Once that flips from up to down, it creates a big squeeze. And that's why these types of elevated thinning out market moves tend to end in a dramatic way. And you can just see there support levels I've drawn on my chart and this rising channel from 2 years ago, which we've broken out of. Any potential unwind back to mean reversion risk to the downside, at the very least, you've got a 10 to 20% downside, which would be super healthy, and more than likely within the time frame of Q3 from end July into August, which tends to be the peak out zone on a seasonality basis. And if you just see here on the right, top right, figure 2, this was one of the reasons why I was still bearish up until we had this fast rotation, fueled by all that liquidity. S&P 500 equal weighted, and the Dow and the Russell were making multi-month lower peaks as tech and mag were leading on the upside. Now we've had a flip side, but the question is, how long does that hold? So if we look at S&P 500 equal weighted going back to its year-to-date high, or the Russell, which it may, because it already is looking a bit too sharp on the upside, then that'll be a lead signal of changes. And obviously with the VIX being so low, that also gives us further upside into where we were March and April, around the 19-20% handle.
I want to get one of those little crowd counters so I can click every time you say bull trap.
Well, they're the most effective patterns in the world. It's essentially, it's a bullish pattern that fails. And that's why it works so well, because it's a big blindside for people in the market, including us. So, if we're too early to call it, obviously if it's proven out wrong, but if and when it does work, and history's proven that many times, what goes up eventually does come down, then the bull or bear trap being the buzzword, is the key behavioral pattern to be watching, along with all the other pattern setups that I'm sure RV viewers will be trading. The second point, as part of that triple whammy factor, is exactly what we were touching on, and it was that opening cartoon, again, of the bull sinking the water with the hot air tech balloons. rotation fragility. Now I'm going to get a little bit techie here with a composite breadth signal, which has been in usage for decades. It's got an ugly name, and for that reason, it's got a little bit of a bad rep. It's called the Hindenburg Omen. All that means is watch out when it triggers, because usually there's a big drawdown or crash. I'm just going for a healthy drawdown crash if and when it happens. But the last time we did see the signal was 2019, and other notable times. Doesn't work all the time, but it does coincide with tops. And just as a quick explanation of what it is, 3 things: strong uptrend, demonstrating signs of exhaustion, high-low expansion, and negative breadth. So we've ticked those boxes for some time now, still watching the signal to see if it plays out. But essentially, it's telling us what we already know, but on a composite index basis, that this rotation is actually starting to be a problem right here and now. And if you look at the right, historically, just to add this big picture context, top right, figure 2, this is as extreme concentration risk as Y2K. I think most Real Vision audience members already know that, because that's been headline news for a while. But that's remained an issue, right? I mean, that still tells us the elastic band is stretched. So while it hasn't snapped back, it's still stretched, and it's still something that where we should caution. And whenever I think about this or talk to clients, or even review the portfolio, the one thing that gets me more concerned now than before, when we've had concentration risk for a very long time, is the fact that now there's a domino effect within the concentration risk. Not only is it historic Y2K extremes, but now we're going from mega cap 5, 4, 3, 2, 1, where I think Nvidia in recent weeks was worth about 30% of the year-to-date performance in S&P 500 alone. And while Nvidia is an amazing stock and currently wobbling as we speak, take care, because that high beta, high concentration is a risk.
It's really an interesting chart to look at this, and this isn't one that I'm familiar with, but it is really interesting to see those 3 kind of peaks on the right, 15, 19, and 24. With 24, it looks like now finally tapping over 19. But when you look back to the left of those charts, man, 2007, 1999, and 1989, those are like ominous red letter dates in U.S. equity market history.
It's a powerful indicator, which has an ugly name, and when it works, it's something to watch out for. But it's certainly one that we have to kind of have our biases in check for, and wait for the market to actually trigger and confirm. And keep in mind, it's telling us what we already know. Market fragility is an issue, and this is just giving us a composite measure of that issue, just to ring that bell when the market has likely crossed the line. We still need to wait for price confirmation. We still need to wait for follow through, but certainly it's something that should keep us alert. Amber light, not red, not green, but certainly amber.
Ron, let me ask you a question, because you made an important clarification earlier in the show between the way you use the term strategic and structural, annual and then longer term cycle basis. When you look at this indicator, and I know you have some other charts that we're going to go and hit in just a minute, but what sort of time horizon are you thinking about this on?
In terms of the potential mean reversion, late cycle stage that we're at, so I think this year holds up. I think if we do get a correction, it'll be healthy, maybe fast, but limited. I think we have a bigger risk ahead into 2025 and beyond, as part of a multi-year shift that will take place. And we've been on borrowed time on a macro long-term basis for some time. If I move back to the actual process, it's based on a roadmap boom-bust cycle developed by my mentor, Robin Griffiths, a leading macro strategist, that actually we interviewed together. It was a great honor and pleasure to do that in a Real Vision studio here in the UK. Watch back for that long form discussion. But essentially we discussed this model and we both agreed that we were still late cycle between WXY. more detail in that interview. But that model is based on these economic cycles. So to your question, secular mega cycles, the top cycle on this chart is the one that influences interest rates, and that's an average of 54 years. So most people ignore it because it's just too big to care about. But in 2022, when we had an inflation and rate shock, that's when this cycle became on everyone's mind, whether people knew about it or not, because we had a cost of living crisis, we had geopolitical flare-ups, and we had a big move on rates, which broke a 40-year downtrend on rates, US 10 yields, and that is still looking like a rolling wave of volatility with a higher for longer trajectory ahead. Although we're unwinding now, my view is still bullish for rates. And one of the big picture charts that we had in that long form discussion with my mentor was the 1970s, where we had three sequential rising waves of inflation. We're in the middle part where inflation is more than halved. It looks like happy days, but we're just about to make a low before we pivot and then rise again. So I do see higher rates, perhaps into year end and the new year, fueled by, the debt situation, but we will likely see it in the commodity complex. And if you look at a ratio of commodities versus equities, super stretched in favor of commodities. Also another chart that we discussed in that interview. And just a quick fast track, the other cycles, just to complete the answer to your question. The jugular or average 10-year cycle is your long business cycle duration. The third down is a variation of that, which is more correlated to the US presidential election cycle, which is super important this year because we're months away. And remember, we already have double-digit elections around the world, I think close to 70 plus, all very important and all very uncertain. And then right at the bottom, the one that people can trade, more tactical, and that is seasonality in terms of sell and may go away, which didn't work so well this year. The one part that is the most reliable part is the September-October drawdown risk, which we're heading into.
It's really interesting. First, I should just say I'm relieved to see there's a cycle whose wavelength is actually longer than I've been alive. That's reassuring somehow. But let me ask you this: when we talk about this, and I know that this is tricky and interesting because you're looking at this along different time horizons, but I want to dig in here. So it sounds like what you're talking about is a short-term cyclical snapback followed by a potentially longer-term decline in 2025. Let me ask you this: in terms of the percent drawdown that you see for the near-term cycle, where we could be in 2024, what do you think that might look like based on the data that you guys look at for this cycle?
So it's market dependent, of course. The markets that have risen the most will suffer from that elastic band effect, as we discussed. Remember that rotation chart, US equities is top of the mix of what was strong and what is now unwinding. And as you quite rightly highlighted, and good shout on your part, the opposite is happening in the rest of the world. So developing markets which are underperforming the US are now starting to, I don't want to say the words outperform, but they're certainly starting to be constructive now and may improve over time. China, open question mark, but certainly others as well. Now, in terms of the move, I invite everyone to draw this trend channel on S&P 500 over the last 2 years, but also use the 20-day average as a tactical timing tool, where it currently is finding support at 55.36. If the S&P 500 breaks below that and we get a reversion on S&P 500 equal weighted, telling us that this rotation did not work, was short-lived, and ultimately failed, then be aware of that behavioral inflection pattern, which is a bull trap, which could have some fast vacuum drop levels into 10 to 20% at the very least. And remember, what matters most in market moves is not just the percentage move, it's the speed of the move. So if that happens fast, then that will create a whole lot of fear, which we haven't had for 6+ months because vol's been super low. And even when it's ticked up, it's been a brief storm before a whole lot of calm. If you look at the statistical graph on the left in blue and purple, that's showing strong levels in the market, but also vacuum levels where if we do get a shift, then we could easily get a fast move. So between 54.80 and 51.80 is one big air pocket in the market. And if we do roll over beneath the 20-day average, that would give a price tactical range within the 10-20% move. And then from a timing perspective is my last part of the triple whammy thesis, but 3 in 1, because the way I do cycles is and the way I do most of my work is at RW Advisories is through a range of different data sets, non-correlated, so that way, the most important signals are coming out. We strip out the noise, but we also focus on what matters. And so from a cycle perspective, there's a mathematical cycle developed by the Foundation for the Study of Cycles, which I'm part of the leadership. There's a seasonality pattern, and there's US presidential election analogs, all suggesting that the market will at least have some pressure in the coming months. So if we look at the mathematical model by the Foundation for the Study of Cycles, this is a difficult story to tell because there's been price and time divergence for some time. So it hasn't worked yet, but, and that does happen from time to time, of course, when markets misbehave and decide to do what they want to do. But it has worked super well in the last year or so. And you can see there, there's a correctly timed peak just into April of this year when we had that mini drawdown effect. Then November of last year, that did actually correctly predict the bottom. So it's not just a bearish indicator, it can be bullish. And you can see the flip side back to a bearish call in July of last year. So it's had a good track record on 3 cycle beats. Right here and now is when the elastic band has been stretched the most, and it looks like it may be skipping a beat. Time will tell. And just very quickly, it either means the signal stops working and the market carries on higher and remains irrational longer than we can be solvent or stay sane, or the rate of change slows down and basically the market just starts to consolidate, or what I'm betting on, we get a potentially short but fast correction within this time frame, likely from August onwards. And the reason why I pin August is if you look at seasonality patterns, average out all the seasonality patterns from a statistical standpoint on US equities, you will get this shape. I did this years ago for a hedge fund client, and I've been using it ever since just because it's worked more often than not. And you can see here the average equity market performance during the July, August, September, and October period looks like this. You get a midsummer rally in July. That definitely worked this year, although you're getting a slower rate of change, and you're getting a thinning out or rapid rotation between tech and value, growth and value. The peak out zone is late August into early September, and then that gives a strong enough lift for that mean reversion move into typically early September, where the biggest part of the drawdown is. People remember October because that's when we get the all-time low, but the big drawdown in September initially. It may happen earlier this year, it may happen later, but certainly be watching your screens from here on out into the month of August and September. And then why this year over and above any other year?
Can I ask a quick question on the cycle?
Yeah, please. Jump in.
So looking at that, it's a pretty stark chart to see that there's that much signal along seasonality, very, very predictable lines. But let me ask you this: how does this change, or doesn't it, in the event of a U.S. presidential election?
Yeah, so there's all types of varied analysis on this. So you'll get different views from different institutions and from different thinkers. And I'm open-minded. I'm not set in my ways on one particular prediction. And if anything I've learned in the few decades I've been doing this, 25 years plus officially, I focus more on preparation than prediction. So prediction's the name of the game, but preparation with prediction is way more powerful. So that way, whatever the outcome, we have a plan or preparation for multiple scenarios. And so right now, I'm looking at the bear case because that's the one that has the biggest risk reward. You know, I think a lot of people have made money year to date, which is a good thing. I'm spending most of my time telling clients to consider trimming, taking a little bit of profit, and having to think about, you know, hedging or a barbell strategy where they continue to be long, keep their clients or their portfolios happy, but develop some kind of risk scenario just in case as part of the preparation. So what does the presidential election cycle suggest? What's my view? My view is based on a base case view that it's typically bullish, but the big exception is during second-term presidents, particularly if it's President Biden. And I'm not saying that from a personal perspective. I'm just going on voting polls, which are historically low. Why does the presidential election cycle impact markets? Very simple. A president wants to get voted in again. So what do? They use their policy levers to prop markets up and keep people happy, and ultimately look to get voted in again. Boy, has that not worked this year. And if you just switch on your TV screens or check your news feeds, it's getting from bad to worse. Now, I'm not saying that we trade the news, which is changing from day to day, but what I am saying is this time is likely different, and it's likely more bearish than it usually is from a presidential election pattern perspective. Now, what this chart shows,
I was just actually sort of thinking it's interesting because this is maybe, I'm not sure, I'd have to fact check this, but this may be the first election in American presidential history where you have two second-term presidents running against each other. I mean, we had Grover Cleveland, who served non-consecutive terms, and I know Theodore Roosevelt ran again, but I don't think they were running against one-term presidents already. I mean, that's a weird moment, right?
It's a weird moment, and it's what I highlighted in the bottom right chart, figure 3, as a unique setup. I think the last time it happened was about 100 years ago. So you're actually good on the history in terms of the fact that it's a big outlier. And you can see here, all we're talking about when we refer to the presidential election cycle. So some people, you know, reference it, some people don't. But if you just think of it in a really simple, logical, clear way, do markets like certainty or not? Typically, yes. And so election season leads to what? Uncertainty. Now, this year hasn't been that uncertain because of the reason that exactly what you just said. We've had both of these presidents twice before, and we knew who they were at the start of the year. Now, typically that doesn't happen. Typically, we don't know who's going to be on the ticket. We have to wait to the debate to happen before we can not only know who they are, but also judge them and their policies. And I won't go there. Everyone has a view on what just happened. But my point is that's what leads to a consolidation in the first few months of this year. That's the typical pattern, and then follows through the midsummer rally. So it basically ties in with the seasonality chart I shared with you based on statistical testing I've done over a long time. That piggybacks off the presidential election average pattern, which is a positive rally during the summer. So that's worked so far. Where it will likely work even more is that third box. I don't know if the mouse is appearing or if you...
Yep, we can see the pointer.
Yeah, so the pointer there, that third box, which is the red box, that's the consolidation into September, October. Why? Because it's literally the last few week countdown into election, and that's when uncertainty flips back again. I'd say uncertainty is happening right here and now as we speak from an election perspective. And then your point about the fact that the nominees are already known and that being unique and it's a century outlier is the bottom right-hand chart. You can see there, this is from Goldman Sachs, looking at, I think, certainty of frontrunners. And you can see there Biden and Trump were top of that chart, which is super rare. Usually that only happens until way closer to elections when people actually vote. And we have a better idea or more certainty of which way to to trade on the back of potential election swings. So that's happened the opposite way around. We know who they are early in the year. We've actually had them twice already as presidents, but you have a whole lot of nuance in terms of some of the headline and drama news that is taking place now, and it's anyone's guess how that might play out. But certainly one of the things that we do is create portfolio baskets and relate that to the potential impact of whichever president it will likely be, and that's something worthwhile doing. But from a timing perspective, just keep in mind the pattern has worked so far. Summer is strong during the presidential election year. There is a nuance now because of the fact that we have so much certainty about these two presidents up until recently. But what is certainly more predictable is the run up to the election tends to be more uncertain and therefore volatile. And the good news from the light at the end of the tunnel is once the election is done, then certainty returns, and we typically get a year-end rally into the new year.
Well, it's interesting. You said two words there, nuance, which certainly applies to your very detailed work and this idea of uncertainty. I try to look and try and pick out signal. Two phrases have really stuck out in my mind from this conversation. The first is bull trap, that you've not said a number of times, and the second is bear case asymmetric risk reward profile. Am I oversimplifying? Am I mischaracterizing to take those 2 points right now as material and significant?
Absolutely. And my closing education behavioral insight is be aware of changes in the cycle and how that can play with your psyche, emotions, and general behavior when you're making decisions under pressure. This chart, which has done the rounds across various institutions, and I use it in all my work, fear, FOLO, fear of losing out, beats greed, FOMO, fear of missing out, in volatile markets. And the stats actually prove it out. You can see the top line there, what happens in terms of equity market portfolio performance if we exclude the 10 worst trades versus the 10 best. So we're still making money in all three lines, but we make the most when we manage the risk, not when we don't, is the long and short of it. And it basically says that risk management and having a healthy fear wins out more often than not. But the real holy grail is being able to do both, make money and manage risk, right? And what's interesting, just to close on two pioneers that have tried to do this, Warren Buffett, who has that famous quote, "Predicting rain doesn't count, building arcs does." So he's really big on tangible risk management. But my all-time favorite is Stanley Druckenmiller, who I know has been on the show and has decades of experience to share. I found out, in recent times that, after a 30-year positive track record, 2000 was the outlier for him. And he goes on the record and says, although he knew that the market was super bullish and that FOMO was strong, he had that feeling to play. He had that urge, that desire to play. And boy, is that so true for a lot of us here and now. So, learn from pioneers in the industry. Remember that, things don't go up forever, and that ultimately FOLO does trump FOMO during volatile markets.
Gosh, what a great place to close. That's just such a pithy summary, such a powerful chart to look at. Great quotes, great insight. Any other final thoughts or key takeaways you'd like to leave us with? I know we've covered a lot of ground here today.
Stay tuned with markets. Focus on preparation more than prediction. And then all the buzzwords that you very kindly captured in terms of what matters most now. I would stay alert and continue to watch how things play out into that negative seasonality window, Q3 onwards, end of July into August, and then of course the lead up to the elections in November. And then of course, just as a side note, happy to follow up with any questions on the RV platform. We'll hopefully be sharing charts and report complimentary for those that want to review. That's a popular question that gets asked after shows that I've done before. So please feel free to send in your questions. Happy to follow up.
Fantastic. Great conversation. Ron Williams, CIO and macro tactical strategist at RW Advisories. Thanks for joining us. Thanks for watching. Thanks for listening. Have a great day, everybody.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.